Welcome back to the deep dive. Usually when you share a stack of sources on something huge like the crypto world, there's sort of a clear story, right? Bulls running or bears digging in. But this latest batch, looking at early November, it's genuinely conflicted, like two different realities happening at once. On one side, you've got this deep market fear, and on the other, well, it looks like massive aggressive building is going on.
That's exactly the puzzle we need to piece together today. That's our mission. Synthesis. We've got to cut through that dissonance you mentioned, because the narratives really are polar opposites. You have this pervasive fear, yet at the same time, institutions and even nations are building out financial infrastructure like there's no tomorrow. So, to navigate this, we've pulled out 6 main themes from the material you sent over. We'll hit the market sentiment first, then the clever regulatory gymnastics around ETFs, also the quite frankly, alarming sophistication of crypto crime. We need to talk about the market performance divergence, too. Big winners, big losers. And then the global push for real-world asset tokenization, or RWA. And finally, we'll touch on that ongoing philosophical debate, gold versus Bitcoin.
Okay, great. Let's frame this up front. Our thesis here, looking at all this, it feels like crypto's hit a new stage. It's less about the hype now, more like a maturing stage, maybe an infrastructure cycle. The foundations are being laid, globally seriously laid, whether Bitcoin's price is up or down this week.
Precisely. It's the show, don't tell phase. And let's start with that emotional state of the market, because it really highlights the contrast with all the building happening behind the scenes.
Right, so the mood. The numbers show it's not exactly cheerful out there. Prices have kind of leveled off after a bumpy ride.
Yeah.
But emotionally, the market feels stressed. That fear and greed index, the one everyone watches for retail sentiment, it's sitting at 37. That's deep in fear territory. Not panic, maybe, but definitely anxious.
And what's really interesting, the paradox here, is that this anxiety is sticking around even though some big global economic worries have actually eased up quite a bit. Your sources pointed specifically to the confirmation of that new U.S.-China trade deal, the one between Trump and Xi Jinping. I mean, that should have been a massive de-risking event for global markets, shouldn't it?
Absolutely huge. Normally, when the U.S. and China signal things are smoothing out trade-wise, I mean, you expect risk assets to rally. Things like Bitcoin, Ether, they're usually seen as risk on. You'd expect them to jump alongside stocks, the S&P 500.
But they didn't. The reports all said prices barely moved. Bitcoin, Ether, they stabilized, sure, but there was no real upward bounce from that positive macro news. And this lack of reaction, especially after what was apparently a really rough October for volatility, it signals a deep-seated caution. It kind of suggests the market's more focused on its own internal crypto stuff, regulatory worries, maybe fallout from earlier sell-offs than on these big global economic signals.
Okay, so if the market isn't jumping on good news and sentiment is low, that leads to the big question, doesn't it? The accumulation theory. If retail investors are scared, is someone else buying?
That's the theory. The accumulation theory suggests that these conditions, this persistent fear, might actually be the start of a new accumulation phase. It's where the psychology shifts. The impatient folks, maybe newer investors who got spooked by the October volatility, they start to give up. They sell, often at a loss, just to get out.
But wait, if the big players, the institutions, the so-called smart money, are buying, shouldn't we see that volume pushing the price up more than just barely moving? That seems like a contradiction.
But that's the key point. It depends how they accumulate. They aren't typically placing huge buy orders on Coinbase or Binance where everyone can see them and the price jumps instantly. They use over-the-counter or OTC desks, sometimes dark pools too. These are private trading venues. Think of it like a big fund wanting to buy, say, $100 million in Bitcoin. They can arrange a direct deal with a large seller off exchange. So the trade happens, massive volume changes hands, but it doesn't hit the public order books. The price on your screen barely flickers. This lets them build up big positions quietly, buying from those anxious sellers, while the visible market price stays relatively stable. It's accumulation in the shadows.
Okay, that clicks. So the retail fear is visible, pushing the index down, but the institutional buying might be happening unseen. And speaking of institutions, we're seeing some really interesting splits, divergences in how crypto-related companies are performing in the public markets. It really shows how volatility is like a double-edged sword.
Absolutely. That same market chop that scares retail can actually be good business for the infrastructure players. And the prime example is Coinbase.
Right, the Coinbase pop. Their quarterly report was strong. Almost $1.9 billion in revenue beat the analysts. And when you look at where the money came from, it wasn't just trading fees bouncing back, although that helped. They highlighted growth in staking income And this is really interesting. Their Layer 2 network, Base, was specifically called out as being profitable.
The base profitability is a really big deal. It signals a shift. Layer 2s like Base make money from sequencing fees, basically, processing lots of small, fast transactions cheaply, and then settling them in batches on the main Ethereum chain. For Coinbase, this is turning into a steady, more predictable revenue stream. It's different from just relying on trading volume, which can go up and down wildly. It's like they're moving from being just a broker to being part of the core tech infrastructure.
Yeah. Okay, so Coinbase is thriving partly because of activity and volatility. But then contrast that with the institutional products tracking Bitcoin itself.
Yeah.
BlackRock's IBIT, the Big Spot Bitcoin ETF, showed some real sensitivity, didn't it?
Yes, exactly. Even with a giant like BlackRock behind it, IBIT saw huge outflows, nearly $290 million in just one day. And it happened right when Bitcoin's price took a dip, specifically when it went below $110,000 briefly. It shows that even though these are massive institutional funds, the capital in them can be quite reactive. Maybe they have automatic sell triggers or psychological levels. When Bitcoin broke that floor, a lot of money headed for the exit fast. It highlights the difference. Institutions building infrastructure, like Coinbase with Base, versus institutions investing in the asset itself via an ETF. The latter is still very much tied to immediate price action.
So we have the exchange doing well, the institutional fund showing nervousness, and then there's this other angle, an investment product designed specifically to profit from all this turbulence.
Right. The REX shares LTI ETF. The volatility harvester. This thing is fascinating. It's basically a bet on chaos. It doesn't care if crypto goes up or down, just that it moves sharply. How does it work? It trades options, calls, and puts on stocks that are known to be high beta.
High beta meaning they swing much more wildly than the overall market.
Exactly. And crucially, the stocks they target include crypto-exposed companies. You mentioned Core Scientific, Gemini, firms whose fortunes are tied to the crypto market's swings. By trading options on these volatile proxies, ULTI aims to capture the premium, the value that comes from those big price movements. It's a sophisticated way for traditional finance players to make money from the very volatility that scares retail investors. The fact that a product like this even exists and attracts capital shows that volatility itself is becoming a recognized tradable asset class.
That's a powerful point. The exchange thriving, the ETF reacting, the volatility fund. It all points to how intertwined crypto now is with Wall Street and how sophisticated the financial plumbing around it has become. And that connection with traditional finance, TradFi, it seems to be getting deeper, faster, partly because the companies wanting in are getting really clever, even aggressive. Let's shift from Wall Street performance to the regulators. October was supposed to be the big month for ETF approvals, but it got delayed.
Yeah, everyone was expecting a wave of spot Bitcoin and Ether ETF launches in October. The issuers seemed confident, but then Washington gridlock hit. The U.S. government shutdown basically put a pause on a lot of SEC decision-making. It wasn't necessarily targeted at crypto, just a side effect of the broader political standstill. The SEC machinery slowed down.
So the SEC didn't say no to the ETFs. They just couldn't really say yes either because of the shutdown.
Right.
But the issuers, they saw an opportunity in that paralysis, didn't they? They didn't just wait patiently. They used this thing called the no delaying amendment.
This is where it gets really interesting, kind of a masterstroke in regulatory strategy, you could say. It hinges on an old, quite technical SEC rule. Normally, an ETF filing gets a 75-day review period, but issuers can file a specific type of amendment that basically says, we're not delaying the process. This shortens the clock to just 20 days. Now, here's the kicker. The rule states that after those 20 days are up, the filing automatically becomes effective. The fund can launch unless the SEC takes explicit official action to stop it, like issuing a formal rejection or a formal notice of delay.
Wow. Okay, so they weaponized the SEC's inaction. Because the SEC was bogged down by the shutdown and couldn't issue that formal stop order in time, the clock ran out and boom, effective by default.
That's exactly how it played out. The sources confirm that major players like Bitwise, Canary Capital, and Grayscale use this tactic. They leveraged the SEC's silence forced by circumstance to essentially push their funds onto the market without waiting for that explicit green light. It's a bold move. It shows these firms are willing to really push the legal boundaries and use procedural mechanisms to get around delays.
And this regulatory workaround has basically shifted the whole timeline, hasn't it?
Yeah.
That's why people are now calling November the new October for ETFs.
Exactly. Now that this pathway has been successfully tested, others are lining up to use it. The sources are pointing to the next wave potentially, including Fidelity's Solana ETF and Canary's XRP ETF, using the same no-delaying amendment strategy.
Okay, so if the SEC doesn't step in, if they stay silent on these filings too, What does that really mean for crypto's integration with traditional finance? This goes beyond just Bitcoin and Ether now.
Oh, the implications are massive. It could really accelerate things. First, it expands the scope of what's considered acceptable for institutional products way beyond the top two coins. Solana, XRP, they're big, yes, but they have different tech, different histories, different regulatory questions around them compared to Bitcoin. If the SEC lets ETFs for these launch, even through silence, it signals the regulatory door might be opening much wider, much faster for a broader range of digital assets.
So potentially, we could see regulated, easy-access investment products for major altcoins hitting the market very soon, like within weeks if the SEC stays quiet.
That's the potential scenario. It means your typical wealth manager, maybe even pension funds down the line, could get access to Solana or XRP exposure through a familiar ETF wrapper, potentially bypassing years of regulatory arguments. It dramatically speeds up integration. It suggests TradFi isn't waiting for regulators to give clear permission anymore. They're finding ways to make the integration happen using the existing rulebook.
Okay, this rapid influx of capital, the institutional embrace, the regulatory maneuvering, it naturally makes you think about the risks, the dark side. Where value congregates, crime inevitably follows. Let's switch gears to that Europol warning. They held a recent conference with the UN and the Basel Institute, and the findings sound pretty serious.
They are. It's a significant alert from top global law enforcement and regulatory bodies. The main takeaway: crypto crime isn't just online scams anymore, it's become highly sophisticated. We're talking about organized criminal networks structurally embedding digital assets into their operations for moving money and hiding funds.
And it's not just about complex blockchain tracing or anything purely digital. The sources mentioned something particularly chilling: the merging of online methods with actual physical violence.
That's the really alarming evolution they highlighted. It's not just remote hacking. Europol shared specific examples from Europe, incidents where criminals physically attacked people, attacked them to force them to give up access to their crypto wallets, their private keys. There's even a term for it now among researchers. They call them wrench attacks.
A wrench attack, as in literally threatening or using physical force, like with a wrench, to steal someone's crypto keys.
Yeah.
That's terrifying. It takes the risk from abstract digital theft to tangible physical danger. Holding a lot of crypto suddenly feels different if that's happening.
It shows these assets are perceived as valuable enough to warrant extreme physical coercion. And the scale of the problem they're trying to tackle is huge. Europol estimates global illicit crypto flows, money laundering, terrorist financing within the crypto system are around $40 billion a year.
40 billion. That's an enormous number. But you mentioned within the crypto system. Does that figure capture everything?
No, and that's a crucial point. That $40 billion mainly covers crimes where crypto is the core mechanism, like crypto-native scams or laundering proceeds from crypto hacks. It often doesn't include all the traditional crime, drug trafficking, arms dealing, human trafficking, where crypto is just used as a payment method along the way. So the total amount of digital currency facilitating broader criminal activity is likely much, much higher than that $40 billion figure suggests.
So faced with this smarter, more violent, and large-scale threat, what are the police, like Europol, asking for? They can't fight digital crime with old methods.
Their demands are urgent and focused on systemic change. Three main things. First, much tighter international cooperation. Criminals use crypto's borderless nature, but law enforcement gets stuck at national boundaries with incompatible laws for seizing assets. They need harmonization. Second, better training. Investigators need specialized skills for crypto forensics, tracing transactions across different blockchains, layer 2s, mixers. It's complex stuff, and many local police forces aren't equipped.
And the third point sounds like it involves the industry itself.
Yes, they're calling for shared forensic tools and better collaboration between governments and the crypto exchanges. This means developing common software standards, information sharing protocols, maybe even ways to rapidly trace and freeze illicit funds across platforms. Right now, it's too fragmented. Criminals can move assets faster than the authorities can coordinate. A unified global approach to tracking and seizure is what they see as essential to stand a chance against this evolving threat. It's like building the security infrastructure to match the financial infrastructure.
Okay, that idea of building infrastructure brings us back to the constructive side, but let's look beyond the West. You mentioned the global infrastructure story, particularly around tokenizing real-world assets, RWAs.
Exactly. This is about putting ownership of tangible things, like a piece of real estate or a bond or even an invoice, onto a blockchain ledger. And while it's happening globally, the sources really zeroed in on Southeast Asia and Malaysia specifically. Their central bank and their Securities Commission just jointly released a pretty comprehensive 3-year national roadmap focused entirely on RWA tokenization. This isn't just talk, it's a formal state-backed plan.
A 3-year roadmap? That sounds serious, planned out. What are the main parts of their plan? What are they actually building?
It's quite methodical. They're setting up a dedicated digital asset innovation hub, basically a regulatory sandbox to let companies experiment safely. Crucially, they're forming a working group that includes not just local players, but international partners too. They want their system to connect globally. And the timeline is deliberate. They're not rushing. Actual pilot programs for specific tokenized assets are slated for 2026 through 2027. It suggests they're focused on getting the foundations right, building for the long haul.
What makes Malaysia's strategy stand out? Is it just the careful planning, or is there something about what they're focusing on tokenizing?
It seems to be the strong emphasis on real-world utility and compliance, rather than just chasing speculative hype. They've been very clear. The priority is use cases that solve actual problems in their economy, things that make finance more efficient. They're actively trying to avoid the speculative frenzy we saw in earlier crypto cycles.
And the examples given are very practical, aren't they? Supply chain finance, tokenized bonds. And you mentioned something about Sharia-compliant instruments. That sounds unique.
Yes, the focus on Sharia-compliant finance is really significant. It shows they're tailoring this technology to their specific regional market and cultural context. Islamic finance has strict rules against interest, riba, and excessive uncertainty, gharar. Tokenization can potentially fit well here. For instance, you can tie a token directly to a tangible underlying asset like property or goods, avoiding pure speculation. And fees can be structured as service charges, not interest. Think about tokenized sukuk. Those are Sharia-compliant bond-like certificates. Putting them on a blockchain could offer much greater transparency, easier fractional ownership, and potentially open up Islamic finance to new investors and capital pools across Asia and the Middle East.
So this isn't just adopting new tech for tech's sake. It's a strategic economic move, using compliant tokenization to potentially unlock huge specific capital markets.
Precisely. And Malaysia isn't alone in this RWA push, although their national strategy is notable. We know Singapore is working on tokenized government bonds, the UK is looking at tokenized trade finance and loans. It all points to this quieter but maybe more profound side of blockchain development, building the plumbing for a more efficient, transparent, and globally interconnected real economy. Malaysia could become a key benchmark for how other emerging markets approach this.
We've hit the market mood, the Wall Street plays, the regulatory battles, the crime angle, and the global building. Let's wrap up the analysis by looking at that fundamental debate about value itself. Gold versus Bitcoin. It's been framed as a rivalry for years, hasn't it? Which one is the better store of value?
It has, but the perspective in your sources suggests it might be time to move past seeing them as direct competitors. The argument is that they're not really enemies fighting for the same throne. Instead, they might represent different stages of monetary evolution. They fulfill different needs and are likely set to coexist.
Okay, coexistence. To get that, we need to be clear on what makes them different. They both derive value from scarcity, but it's a different kind of scarcity, right? Let's start with gold.
Gold is the original hard asset. Its value comes from its physical scarcity. It's rare, it's hard and expensive to mine more of it, it doesn't corrode, you can touch it, it's been trusted for millennia. But that physicality is also its limitation in our digital world. It's heavy, costly to store securely, slow, and expensive to move across borders, and verifying ownership often relies on trusting vaults or intermediaries. High friction, as you said.
Physical scarcity, high friction, and Bitcoin. That's the digital answer.
Exactly. Bitcoin represents digital scarcity. Its supply limit, 21 million coins, is fixed by code, not by geology. It's verifiable instantly by anyone on the public ledger. It's weightless, borderless, can be sent anywhere almost instantly for relatively low fees, and you can hold it yourself without needing a bank or vault self-custody. Its value comes from this digital utility and its network effect.
So the coexistence thesis basically says, as finance gets more digital, tokenized, we'll still need both. Gold for one role, Bitcoin for another.
That's the idea. Gold likely remains the ultimate conservative anchor. Central banks, large traditional wealth managers, people looking for that tangible, millennia-tested hedge against inflation and crisis, they'll probably keep holding gold. It's the physical bedrock. Bitcoin, on the other hand, becomes the native hard asset of the digital age. It's the programmable, fast-moving, borderless store of value and medium of exchange needed for a high-speed, internet-based global economy. The digital frontier of hard money.
You mentioned programmable scarcity. That seems like a crucial difference gold just doesn't have. What does that programmability actually allow Bitcoin to do that gold can't?
That's where DeFi, decentralized finance, comes in. Because Bitcoin exists as data on a network, it can interact with smart contracts. Gold bars sitting in a vault can't do that directly. You can lock your Bitcoin into a DeFi protocol and use it as collateral to borrow stablecoins, or lend it out to earn yield, or use it in complex automated trading strategies. These contracts can automatically manage the collateral, liquidate it if the loan terms aren't met, all without needing a traditional intermediary. It's active, dynamic utility that physical gold only gets if it's first tokenized and put into someone else's custody. Bitcoin's native digital scarcity makes it a functional component in this new financial architecture.
And practically speaking, for the everyday investor trying to navigate this, the rise of ETFs and tokenized products for both gold and Bitcoin kind of makes the philosophical debate less critical, doesn't it?
It really does simplify things on the access front. You can now buy a spot Bitcoin ETF almost as easily as a gold ETF, or maybe soon, tokenized gold custodied by a reputable firm. So investors aren't forced into an either camp anymore. They can just decide how much exposure they want to hard assets and allocate between the physical anchor, gold, maybe via an ETF, and the digital frontier, Bitcoin, also maybe via an ETF, side by side in their portfolio. Access is becoming much easier for both. Okay, so we've journeyed through fear, innovation, crime, global building, a really mixed bag. Let's try to tie it all together now, synthesize it as you appreciate. What emerges is this picture of uneven, sometimes messy, but undeniable progress towards a more mature crypto ecosystem. The system is evolving fast, even if sentiment lags.
Right. We have retail sentiment stuck in fear, the index is low, yet at the same time, big players like Coinbase are posting record revenues, and ETF issuers are aggressively pushing new products onto the market using clever tactics.
Exactly. And you have regulators being cautious, maybe slow due to bureaucracy or politics leading to delays, yet innovation finds ways around it, like that no delaying amendment loophole, forcing the issue and accelerating product launches anyway.
Then there's the dark side. Criminals are getting smarter, using horrible tactics like physical wrench attacks. But law enforcement isn't standing still. They're pushing back, demanding global cooperation and better tools to fight this sophisticated crime.
And while the West grapples with these ETF battles and crime waves, you look east and see nations like Malaysia methodically building the foundations for the next wave, compliant, utility-focused RWA tokenization, even tailored to specific regional needs like Islamic finance. It all reinforces that core thesis. Crypto's in its infrastructure phase now. The focus is shifting from pure speculation to building the actual rails.
Okay, so as our listeners process all this, what are the key things they should be watching for, say, through the rest of November and into next year? What are the signposts?
4 things stand out. First, definitely the altcoin ETF landscape. Keep a very close eye on the SEC's response, or lack thereof, to those no-delaying amendment filings for things like Solana and XRP ETFs. If those launch without an explicit SEC block, it's a major signal that regulated access is broadening beyond Bitcoin and Ether much faster than expected. It could pour fuel on the altcoin fire. Second, watch for announcements around global security and forensic standards. After that Europol and Basel meeting, expect follow-up. Look for joint statements or initiatives proposing new international frameworks for tracking illicit crypto flows. How quickly and effectively can they build the tools to combat that $40 billion problem?
Okay, ETFs, security standards. Third,
RWA execution in emerging markets. Specifically, keep tabs on Malaysia's progress as they move towards those 2026-27 pilot programs. Are they successful in tokenizing supply chains? Do the Sharia-compliant products gain traction? Their real-world execution will be a crucial case study for how other nations might integrate blockchain into their regulated economies.
and the last one ties back to that philosophical debate.
Yes. Fourth, watch the complementary safe haven thesis in action. How do Bitcoin and gold actually behave in the markets, especially if we see more global economic uncertainty, like inflation staying sticky or worries about liquidity? Do they move together as hedges against fiat currency problems, reinforcing the coexistence idea? Or do they still trade like competitors? Market behavior will tell us a lot about how sophisticated investors truly view their respective roles now.
That's a great wrap-up. So to summarize our deep dive today, yes, the crypto charts might look red, sentiment might feel low, there's anxiety out there, But beneath that surface noise, the sources clearly show the engines of integration and infrastructure are running hot. ETF loopholes are being exploited, real-world assets are being tokenized nation by nation. Even law enforcement is adapting. Crypto isn't just one thing anymore, not just an asset. It's becoming a set of tools, rails, and fundamental ideas reshaping finance.
And let me leave you with one final thought to chew on, building on all this. We agree, scarcity is key to value. Gold gives us physical scarcity. Bitcoin gives us digital scarcity. Both seem increasingly accepted. So the really interesting question for the future is, what new financial tools and mechanisms will emerge to bridge the gap, to fully leverage the unique properties of both? How do we best utilize hard money you can touch, alongside hard money you can program? The real edge might soon belong to those who master the programmable utility of digital scarcity.